Canoe EIT has a history of weathering everything the economy can throw at them. But with 2025 set to be a year like none other, are they ready for the challenge? Fasten your seatbelts, folks. This is going to be a good one. For Canadian investors looking for steady dividend income, Canoe EIT has long been a trusted name for sure. With their impressive track record of reliable payouts, EIT has built a strong reputation. But can they maintain that reliability in the turbulent waters of escalating Trump tariffs and, well, that looming recession? Canoe has been for a very long time a name that has been synonymous with reliability. That 10-cent dividend, it never misses a beat, despite what the market is doing. So what is it that makes Canoe so reliable? They have a nicely diversified portfolio that spans Canadian equities, global stocks, and of course fixed income securities. This really goes a long way to help smooth out their volatility. In addition, Canoe's management team, they have a strong track record for sure of delivering for investors who prioritize that steady income. A sub to the channel allows for you to prioritize future content. Before we get into Canoe's fundamentals, I think it is worth taking a look at how they are structured, as well, it really can help you understand why this fund has been so good throughout the years. Right out of the gate, they are a closed-end fund. This means that they trade like a stock on the TSX under, of course, that ticker EIT.UN. But it does also mean that their shares are limited. Even though it trades like a stock, it also has many of the advantages of an ETF. In fact, its structure often leads to Canoe trading at a premium or discount to their NAV. They invest globally with about 60% in equities, including Canadian blue chip stocks like banks and energy firms, and 30% in bonds those are for the stability aspect of the fund. The rest is cash or alternative assets, which adds a lot of flexibility to the fund. Their overall mix aims to balance growth and income. Canoe does employ leverage, so they will borrow to boost their returns, which we know means they can, it's going to amplify their gains, and, it'll also amplify those losses as well. This adds extra risk for sure. Now, with a recession expected in 2025, the management team is already beginning to prepare. They have increased exposure to defensive sectors like utilities and consumer staples, which, of course, they tend to hold up when the economy slows. They're also keeping a cash buffer to see some opportunities if those markets dip. Yes, Canoe will buy the dip. The bond portion, that helps cushion their volatility, but leverage could hurt if markets tank. Now, historically, Canoe has weathered economic downturns by one of the strategies is, by cutting back on that leverage and focusing on more high quality assets. And I expect the coming recession to be no different. In terms of the trade war, Canoe could face some impacts from the 10% tariffs on energy exports to the US. They will have to shift some of their holdings without a doubt to minimize some of the larger tariff impacts. Luckily, their global diversification will add some protection for sure. Tariffs will add some uncertainty to the mix without a doubt, but Canoe should have a very good chance of coming through 2025 and beyond in pretty darn good shape. Okay, I think we are ready to jump into their fundamentals. If there are numbers involved, we need to call on the elder of equity, the Raja of returns, the one and only Mr. Math. We will, as usual, start off with a little bit of their surface data. So at the time of recording, their current value is coming in at $14.81. And they've got a market cap of $2.62 billion. Their beta, pretty darn average, 0.99. Earnings per share coming in at 0.74. That price to earnings ratio, 19.95. Looking at their return on equity, that comes in, and I love this number, 24.90%. Return on assets, 14.36%. That's very respectable as well. These numbers, they look great. Of course, I'm a huge fan of a good ROE value, and This one thrills me for sure. Okay, let's dive a little deeper and take a look at their cash situation. Their current revenue comes in at $701.68 million per year. Their earnings coming in at $637.59 million. Their profit margin, it's a nice one, 90.87%. And now, mind you, they did have a really good year. Free cash flow coming in at 315.12 million. Operating cash flow coming in at 315.12 million. It is really nice to see the positive cash flow. If you remember the last time we peeked in, well, it was in the negative, but that was of course due to some asset purchases that had eaten away at their cash flow temporarily. Let's take a look at their fair value. So once again, their current value is coming in at $14.81. Using a discounted cash flow model, we get a fair value of $21.38. So that does paint them as being undervalued by a good 30.8%. We do not have a one-year target for Canoe. Canoe behaves like an ETF, and well, the analysts treat it like an ETF. They tend not to give targets for ETFs. Once again, I am liking these numbers quite a bit, especially that profit margin. That was pretty darn good. Okay, let's peel back another layer and take a look at their returns data. We will start with their dividend. They have a yield of 8.108%. That's a monthly dividend of 10 cents per share. And the payout ratio on that, 68.90%. Their 5-year average dividend increase, that is at 0. They have not changed that dividend in, well, forever. I know many of us would love to see an 11-cent dividend, but I wouldn't get too excited, as I suspect that is not going to happen anytime soon. On their 3-year return on investment, that's coming in at 12.20%. Factor in the dividends, total return 39.47%. Looking at their 1 year, that return on investment 8.10%. Adding in the dividends, total return 16.86%. And their 3-year annualized 11.73%. These are definitely solid returns, and they have had a very good record lately, and I do feel they're not about to start disappointing me anytime soon. Okay, let's take that final dive into their debt data. Their total debt is coming in at 269.83 million, and their total equity is coming in at 2.80 billion. So that's a debt to equity ratio of 9.6%. Now, 5 years ago, that debt to equity ratio, well, it was sitting at 24.2%. So they've improved their overall debt situation big time. Looking at their cash and cash equivalents, that's coming in at 109.97 million. On the short term, they have assets of 115.66 million, liabilities a wee bit higher, 126.50 million. Looking on their long term, oh boy, this is an interesting one. The assets are coming in at 2.98 billion. Those liabilities, 165.67 million. That's not too shabby. Their debt situation is pretty darn good for sure. I really don't have anything to complain about. They've got everything covered. They've got everything covered. Very little debt. What can I say? In terms of share dilution, nada, none, zilch, not this time around. I'm also going to add, in the last 3 months, they have seen significant insider buying with 185,000 shares being purchased. So that's pretty good. Okay, I do think we are ready for the final verdict. I am still a huge fan of Canoe EIT, and even with the much higher yields out there, I still have plenty of room in my portfolio for them. This is a solid stock for most investors who are looking for reliable income with a wee bit of growth on the side. I do have to add that tax-wise, this is a fund that can employ return of capital, so it can be more tax efficient in a registered account. I am going to throw a monkey wrench at what I just said, because in 2024, they had a fantastic year. They did not employ any return of capital. In fact, most of their dividends were classified as capital gains, and that really is reflective of their huge growth during 2024 for sure. 2025 is going to be a real test for many stocks, including Canoe. I do believe they have what it takes to pass mostly unscathed to the other side of that, well, of the current financial chaos and the chaos to come. If you are interested in Canoe EIT, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learny dirty by checking out this video on industrial tariff-proof stocks. Thank you for watching, and I will see you in the next video.